Welcome to the weekly update, where I'll go over the action in the market for the week of November 4th through the 8th, and then we'll see how things look for the week of November 11th through the 15th. Well, the election's finally over. It's not completely final. It won't be final until December and then official until January. But the stock market seems to really like the fact that we're finished with the election and they like the way things are going. Now, typically what will happen is the stock market anyway, it likes a split Congress between Republican and Democrat. And it looks like the Republicans have been able to have the majority now in the Senate. It's contested in the House, but at the time I record this, it's still leaning in the Republican fashion there. And of course, the White House would be Republican. And there's really no edge when it comes to Republican or Democrat as far as the stock market is concerned, because they treat politics as political theater. Yeah, it can affect the economy and it can affect things back and forth that way. But what the stock market really likes is when Congress is divided because Congress has a tendency to pass rules and regulations and that restrict things and that make things more complicated and it costs more money. But at least for right now, the market likes the way the election appears to be turning out. So we just have that relief that's going on. And this week ended up being pretty much the most positive reaction after the election that we've ever seen before. And things are looking quite positive right now. Maybe a little too positive because we're never able to go in just one direction. We don't just shoot up or shoot down. We stair step higher or lower. And there are some really positive looking things. When you look at the longer term trend, we are positive. There, of course, are some bumps along the way. We had the Fed come out this past week. They cut interest rates another 0.25%. The market seemed to like that, even though it didn't really react to that. It was pretty much anticipated that was going to happen. And we're coming into a period of positive seasonality. Now that we're into November and through December, January, even going out into April of 2025, this tends to be the most positive time of the year for stocks. But there's always these crazy things that can happen, things that come in that could spook the markets a little bit, or different events going on geopolitically, weird things that could happen within the US. But for right now, the market anyway seems to be pretty positive about where things are at. Before I get into looking at the charts, the daily video is really where I do my analysis. Yeah, my videos are longer. I have a lot of charts. That's the way you see incremental little changes in the market. That's really what technical analysis is. It's not trying to forecast. It's not trying to say this and that are going to happen. It's taking an evaluation of where are we right now. And so that's where we use the information to base our decisions. And you'll get that in the daily videos. There is a PDF available in the description below this video that has the slides of not only what you're seeing here, but the charts. Every day I update pivot points on the YouTube community tab, and those can be very helpful as well. There's a private Facebook group, not really active, not an awful lot of members, but if you want to join and change that, if you have any questions for me, if you want to have some back and forth, that's a way to do that if you belong to Facebook. And I really keep a close eye on comments. I'm getting a lot of spam again from the scammers who say they're social media experts. And so I just go through and delete those. And I also post on Rumble, and that's kind of a backup. So I post on both platforms. Excuse me. And here's the link to the Rumble channel. Also, I have a thing called the SPX Investing Program. It's up, it's going, it's still free until the end of 2024. There's a link that'll take you to the website. There's a link that'll take you to a video. If you have any questions, you're more than welcome to email me here at the address provided. Also, as I said before, the daily video, that's the real foundation. The weekly videos tie in to the daily video. You have to excuse my voice a little bit. I seem to be fighting a bit of a bug right now. Okay, let's go back and talk about this week's session. For the week, we were up 4.66%. That's a really healthy move in just a week's time. And volume was above average, so we've been seeing that really picking back up as well. And we are positive. When you look at the technical picture, our trend is positive. We seem to be holding up for right now. There's always areas of concern. That's why we're going to go through the charts and look at those. And interest rates, the Fed has been cutting them. Another thing that was kind of healthy, right after the election, interest rates went up. But then for the week, they ended up coming down. And the stock market likes the fact that interest rates are coming down. The dollar has been really strong too. And typically the stock market likes a weaker dollar because the exchange rate and import and export relationships, that's more favorable to make a company's books look better. But we want to keep an eye on all the geopolitical things going on. There's this window of time now before things actually switch over. Is something going to happen either in the US or across the globe that could have an impact on the markets? And we did get some Fed speak this past week. Chairperson Powell had the press conference, but nothing that really gyrated the market, either positive or negative. The market had been going up and it just kept going up after the press conference. And as far as our trend, we are still positive, but it's a weakening trend because the ADX is below the moving average. And I'll show you that chart here. So just some bullet points. Stocks had a very positive week, and it was across the board, not just the large caps, but the mid caps, the small caps even had a good week as well. Earnings reports that came out were, for the most part, taken positive. The Fed did come in and cut rates 0.25%, and the election is over, and I have that in quotes because it's not officially over. We know the results, but is that going to be what ultimately are the official results? And the day after the election logged the biggest post-election performance ever. Folks just love these kind of statistics here. And there was a real relief factor that this won't be a contested election because it ended up not being as close as a lot of people thought. And so there's not an awful lot of, well, cheating went on or this manipulation went on and this happened and that happened and things should not be accepted for the way they are. And that the market did like that. And it probably would have seen the same result had things gone the other way. The idea that we have an election process in the US and that there is a peaceful transfer of power, that's a big thing. And that's not been what's happened through most of history. It has been what's happened through the US. And to see that challenged a little bit causes concern and confidence in the overall system. And it looks like the growth factor is back now, meaning that okay, the economy can grow, inflation seems to be under control, and there's the idea that these new things can happen. There might be some reforms to take care of some of the waste, and the market just feels pretty confident, with participants thinking that President-elect Trump's aim to lower taxes, because the tax cuts that we're still enjoying right now, those were set to expire in 2025. And there was a fear that they would not be renewed if Harris had won and there had been more of Democratic leadership in Congress and more seats there. And then another thing that Trump did in his first term is that he cut a lot of regulations, and that's what the market really likes. And these things all taken together help promote economic growth. Okay, small caps, financial stocks. Now, financial stocks had already been doing well. Small caps have been pretty frustrating in 2024. Is this time different? Are they finally going to break out and be able to really move to the upside? They break out and have a couple of good days and then spend a week or so giving all those gains back. Is it going to change? Or the financial stocks? And we watch those mainly to see, yeah, the financial sector is a huge part of the US economy. But if we start to see weakness in those areas, that could indicate some kind of financial problem. And To this point, that has not been happening. And the dollar rose against other major currencies. Bitcoin, even, it's like everything went up. And the cyclical sectors, they cycle through the economy. So these stocks tend to do better when the economy is doing better and do worse when the economy is doing worse. And right now, the cyclical areas of the market are doing quite well. Tesla, my goodness, was up 29% for the week. And some of that probably had to do with the support that Elon Musk gave to Trump. And Elon Musk is possibly going to become part of the administration. And the market kind of like that. Interest rates ended up falling. We closed at 4.31% with a 10-year yield, where we had been a week ago at 4.36%. And when Chair Powell gave the press conference, he didn't remove the possibility of another 25 basis point cut in December. He didn't come out and say it, but he didn't not say it either. So for the week, the Dow ended up being up 4.6%, hitting new all-time highs throughout the week. We had the Nasdaq hitting new all-time highs, up 5.7%, the S&P up 4.7%, and the Russell 2000 small caps were up 8.6%. And then I've been showing this chart for well over a year and a half now. We're still where this blue line is, the light blue line, where we're coming down with inflation for the most part. And that this it tends to be the period that we're in. The reason I keep showing this chart is look what happened after that, because things can change. And of course, everybody has an opinion. They think, well, Trump, there's going to be inflation and prices are going to go up. And that could be true. That's one of the reasons why we've been concerned about interest rates going back up, because that could mean there's economic growth going on. And to try to ward off inflation, that's why interest rates go back up. But are we going to get into a place of hyperinflation? That we don't know that. Of course, people can have all conclusions and they can come up with whatever forecasts they want. We follow the charts here and just look at the evidence as it unfolds. And we're at 4.31%, so we're above that 4.02 level. It would be nice if interest rates kept coming down, especially when you look at it, how does that impact earnings for stocks? And this was updated a week ago now. These are folks that are unemployed for 27 weeks and over. It did go up in the latest reading here, but we won't get another update of this until the beginning of December. And then earnings are still looking good going forward here. And interest rates, for the most part, are going down. Whether we look at the purple line, that's how they feel now, or how they felt a week ago. The fact that this is a little bit higher is they're saying, okay, maybe the economy can grow. Interest rates are still headed down, but they might be a little bit higher than what we thought last week. And earnings per share, they're growing. They came in at 8% year over year. That's the dark blue dot right here, where they expected them to come in 3%. Now, I look at all kinds of different earnings charts and forecasts and things, and they're all different. But the takeaway from this is it was better than expected, at least to this point. And CEO confidence is showing a little bit of an improvement here, and that's good. And then if you look at the how long the average bull market has lasted, it's about 50 months. So, you know, we're just about halfway through that right now. We're about 25 months into that. And the average has a return of 152%, and we've had a 65% return. And we bottomed back in October of 2022. So we're just getting to that point of being a little over 2 years old. And you can look back in history at other times. Some have been shorter, some have been longer. That's why we take the average up here. And then the sensitivity of the earnings per share when the tax rate, not interest rates, but the tax rate either goes up or down. And small caps have a real tendency to benefit from that because these are smaller companies and they have to borrow a lot of money. And the higher interest rates they're paying, the more that bites into their corporate profits. But there's a positive overall impact with interest rates or tax rates, excuse me, actually going down. FactSet, it says S&P 500 companies that are discussing the election on their calls, it was up from before. versus what we saw back in 2020? And are they talking about Harris? That's blue. If they're talking more about Trump, that is red. So yeah, it was on everybody's mind. It's definitely something that companies have to deal with. And then our analysts cutting earnings per share more than average. That's the key qualifier here in this more than average for the fourth quarter here? The answer is no. They are cutting them. That's the blue dashed line that you see over here. But the solid blue line, that's the average. So even though they're cutting them, it's still above this other line. This presents it in a little bit different format right here. So yeah, they're cutting them, but not more than average. And then how is the earnings season unfolding here? 91% of S&P 500 companies have now reported. 75 of those that have reported, they're above their earnings per share estimates. And again, they tend to lowball this. They want the earnings report to come out and with the idea that they'll get some kind of a bump in the stock price. When you take it all together, the earnings are 4.3% above estimates. So again, another little way of looking at this, where the chart we looked at earlier is saying 8%. So yeah. All right. Here is the daily chart right here. And we were up in the intraday chart, both, well, we were pretty much flat in Monday's session because it's like, okay, do we really want to take on some major positions here ahead of the election? But then things were fairly positive during election day, and then we saw just a massive gap higher going into Wednesday's session with things leaning more Republican here, and we ended up closing pretty much at the high. We went up again on Thursday, and we closed a little bit off the high on Friday, but just massively seeing a lot of improvement here. A lot of euphoria, a lot of fear of being left behind here, FOMO. And because this is emotionally driven and people are not afraid to go in and sell, they're afraid that they're not going to go in and buy. That's when the market can get a little bit toppy and a little bit overextended, at least in the positive side of things. So look at the whole week here. All of the indexes that we follow were up with the small caps actually leading the way. We haven't seen that in a while. The Nasdaq has been doing well. The Nasdaq 100, we have the S&P. It's been one of the stronger indexes in 2024. It did well, but it underperformed slightly for the week. And you've got the NYSE also setting new all-time highs. And then going back to the beginning of the year, we still have the Nasdaq 100, which had been dropping because they hit a high back in July and they've been lagging ever since then. Well, now they could potentially be coming in to take over that leadership role again. And that's what really helps the market to move up. And then in third place is the S&P 500, but now all of the indexes are well positive year to date. And it's different sectors. All of them ended up being up with discretionary. And this is Tesla, this is Amazon.com. Those companies doing well, that really helps that overall sector. These are the things that make life fun. And energy saw a bit of a bounce back up as well. With the tech sector, that's a growth area. Communication, that's another growth area. And staples, they were up, but that's more of a defensive area, as are utilities. So all of these areas ended up being up. It's like buy everything here. But these other more defensive areas like healthcare, utilities, and staples, they weren't up as much. And then sorted in a different way, looking at the scooter score on a scale of 0 to 100, we still have discretionary, the financials, communication, those are in the 90s. And discretionary and communication, those are growth areas. Those are areas that we want to do well that can really push the market higher. But at the same time, since they're doing quite well, at some point, folks are going to want to come in and take some profits, which could lead to some sideways to even declining action where you see staples, healthcare, energy, these sectors aren't as strong right now. Then for the week, showing how the different sectors perform, we were kind of split down the middle with discretionary really doing quite well. And then the more defensive areas, staples, materials, that's tends to be more cyclical. It does better when the economy's doing better. Real estate still under pressure because interest rates have been going back up. Utilities, which had been really strong, we're seeing some weakness there. And then healthcare, another defensive area because you need healthcare no matter what's going on in the economy. And then year to date, we have communication. Financials are positive with tech being slightly negative the way this is measured here. And all of the other sectors so far are continuing to underperform the S&P. Then this might look a little bit different if you've seen these charts before. These are the relative rotation graphs. It's the same information. They just presented it at stockcharts.com in a little bit different way, where we had utilities and real estate doing better, but now they've been showing some weakness here as interest rates have been going back up, as the market could potentially be shifting back over to more of a growth stance. And so we're seeing things that are improving, like discretionary. The financials are doing well. We're seeing an improvement, a little bit of an improvement here with energy, but XLK, that's tech. We want to see that doing a little bit better. XLB or materials. So some of the areas that have been stronger are showing a little bit of weakness that were more defensive, and some of the more growth areas could be coming back in and showing an improvement. This is what it looks like in a spreadsheet type of format where we have communication, industrials, discretionary, and financials. Those are good, solid areas there. Utilities and real estate, kind of more in the neutral area right now, where negative would be staples and healthcare. Those are defensive. And then just kind of holding up for the time being, materials, tech, we would like to see that doing better. Energy, which had been very weak, is seeing a bit of a bounce back there. Looking at the different indexes where we had utilities really strong, but you can see it's yellow and it's going down and it's a very long tail here. They're not as strong as they were before. And we're seeing things like the S&P 500 and S&P 100 going up just a little bit, but not as strong as we would like them to be. What's really coming on are the transports and the mid caps. Now, mid caps were strong earlier in 2024. Then they just kind of fluttered around for a while. Transports were just kind of chopping sideways. This improving could really help the market as well. Still seeing some weakness in the small caps. Now, it had a great week, but this is a going back over a year. And it's been kind of disappointing for small caps, and we'll be waiting to see if that is going to end up changing. And then the NASDAQ 100, which had been weaker, it's now showing a little bit of an improvement here. And here's the spreadsheet format with the Dow coming off of all-time highs, S&P all-time highs, S&P 100, NASDAQ 100 finally setting another new all-time highs. The utilities seeing some weakness here. Small caps are still negative overall, but improving. Mid caps and then the transportation index as well. As far as sentiment, the latest reading from Investors Intelligence, nothing really positive. Now, this is a week old, and this was put out November 5th, but it's from the previous week. So we'll have to see what kind of a change comes out in the next reading. And looking at some sentiment indicators, this Goldman Sachs reading here, it doesn't really have things looking all that extreme. When we get above the one standard deviation here, that's when sentiment gets to be a little too positive. But this chart was earlier in the week. Now we're seeing a different version of sentiment here. Yeah, we're getting kind of extended to the upside. Folks are getting a little too exuberant with this. And when we look at the gauge that I follow every day, we're not extreme at this point. We had been coming down into the fear area. We were dropping well below 50 with things bouncing back up. We're going back, and I call this positive instead of greed. It's just when we start to get extreme positive or extreme negative, that's when we pay the most attention to this. But at the same time, we look at the context of what way is the line actually moving. It had been going down as we were leading up to the election, and now it's starting to go back up after the election has been completed. Active asset managers showing a little bit of an improvement here, but not above the red line yet. Coming in at 88.31. It's when we get above 90. That's when they start to look more extreme. And the VIX, which had been above 20, and it was there even a week ago. We're hitting all-time highs with the S&P, and the VIX is coming in right around the 20 level. Well, we really dropped off. after the election, we're seeing a real decrease in the value of the VIX, both with the line chart and the bar chart. And seasonally, or beginning of November, if you could line it up here, we were seeing a very high VIX reading. And the red line here is what's happening now, but it hasn't been updated in a few days. If this continues to drop, that will be more positive because as the VIX declines, the stock market is typically going up. Another one, the VIX index to election day. Here we have election day where we see a little bit of a climb up with the VIX. And then after that, quite often we see a drop off as we have like a relief rally here. And this just goes back to 1996 and it's a median. So there's just, you can take the same information and just manipulate it in a lot of different ways here. We're still looking really good with this when we compare cash to the tech sector with the black line going down and well below the cloud. That's positive for the tech sector. The right X bear bull ratio still coming in with very low readings. That means most folks are into the bullish funds. They're positive on the market. The Ulcer index on the weekly chart, we're above the moving average on the daily chart. We're a little bit below the moving average here on the weekly chart. Not really seeing any risk here. When we look at the spread between risky and not as risky bonds, and when this is getting a very high reading, this is inverted. So that means that there's very minimal risk being perceived between the risky and not as risky bonds in the bond market. Seeing a bit of an improvement here with the American Association of Individual Investors, but not an extreme reading currently. And we're coming down just a little bit here. When we take the VIX and the 3-month average of the VIX, we've been really going up as the VIX was giving very high readings. Well, with the VIX starting to come down, we could be coming down a bit with this ratio. And longer term with the equity put call ratio, it continues to decline, which is more positive for the market. It just means there's less hedging going on. And the latest reading of the national financial conditions still below the black line. That's positive. Latest reading from GDP Now coming in at about 2.5% or so. The forecasts are about 2.25% maybe to the upside, to about 1.5% to the downside. Positive GDP there. Also looking at positive GDP this way, not really suggesting that we'll go into a recession. And this was updated a week ago. This is a real-time SOM rural recession indicator. It came in above the red line of zero point 0.5. Well, since that time, it's been coming back down, and we're getting the latest reading at 0.43. When we get above the red line, that really signals that we could be heading into a recession. And the other smooth U.S. recession probabilities still below the black line at the latest reading. Brave butter still not really showing a fear of a recession there. Inflation, and we are going to get CPI and PPI in the upcoming week. So there'll be some adjustments to this, but not really big changes when it comes to inflation. And now that the November meeting is finished, now we start to focus on the December meeting. As of Friday's close, there's a 64.6% chance that they're going to cut rates another 25 basis points. But they're not fully in that camp yet. And this is going to change as we get closer to that meeting. This is showing actually a little bit less of a conviction that they're going to cut rates another 25 basis points again. This is going to change a lot. Now we're starting to look out to the January 2025 meeting, and they still think that we're going to be right around that 4.25 to 4.5%, which would be 25 basis points lower than where we're at now. So there's really been no conviction about what's going to happen. Some think a little bit more, that they'll cut them a little bit more. Some think that we're going to keep them the same. And this is showing how things are kind of changing over a period of time. But it's so far out, we're just watching this more just to see how it's changing. The Fed balance sheet shows that it's still decreasing overall, and this is the year-over-year change over here, where, believe it or not, it's a minus number, but this line just continues to go up. And the overnight reverse repurchase agreement still not really showing us any massive change right now. We watch this to see if something weird is happening, And then that will apply to specifically the banks. Looking at breadth, coming in pretty strong right now when we look at the advanced decline line based on price and volume above the moving averages. Looking fairly good when we look at the daily chart. Even though we haven't surpassed the previous high based on price, we're actually looking a little bit stronger based on volume with the daily charts. And just a massive increase in the new highs over the past week, but we're still going down with the 4-week. We're starting to go back up with the 10-week moving average. Looking more positive here, above zero and going back up with the 19 and 39-day advanced decline ratio. The accumulation distribution looking pretty good here. We could be getting a little bit far away from the moving average, but we're above the red line and the line's going up. So longer term, that's positive. And after going negative for a few days on the daily chart, we're now switching back to positive on the daily chart. And our trend, this is what I mean by a weakening trend. The ADX, which is the black line, it's pretty much flat right now, but it's still below its moving average. But we're positive because the green line is going up and the red line's going down. The Erin indicator is above zero with the oscillator. That's still positive there. No signal with the mass index right now. The daily chart, it come down and we're hitting pretty good support here at the 50-day moving averages. And now we've been going back up. We're above this intraday pivot point. And this is what I update on the YouTube community tab. If you want to see how they are they last for the whole month. And then I have a chart that of pivot points that last just for that particular day. Positive across the board with the Keller market model on all time frames, on all indexes. We're negative still with bonds based on price in the short and intermediate term. We've switched to negative with commodities in the short term and long term. The dollar is positive in the short and intermediate term. Little change here with the decision point scorecard. Positive across the board in the short, intermediate, and long term with the two different models that they show here. Still looking really solid coming up to the high end of this trend channel going back to 2009 for the S&P. And just really looking solid here, well above the pivot point right now. And as far as the trend going up, the red line's going up. So the 50-week simple moving average is still looking really solid. The long-term trend is intact here. Then we use the crossover system. The blue line's above the red line, and we're setting all-time highs with the S&P. Crossing back above zero with the McClellan oscillator, that's turning this more positive. But we're still declining with the summation index based on price. However, we're still above zero. So we're positive but declining. We're also turning back up a little bit here based on volume, but we're still above zero. So we're positive there. Saw an improvement here with the Swenlin trading oscillator based on price and volume. We're above zero and advancing. And we're seeing an improvement with the bullish percent index. It had been declining. Now it's starting to go back up, and that's more positive. And still seeing a little bit of a mix up here with momentum, trying to turn back positive with the PMO after it had been trying to turn negative. A little bit below zero here with based on price, declining but still positive based on volume. Saw an improvement with the PMOs that are rising. The buy signals are going up, and we're starting to see a little bit of an improvement with the PMOs above zero. And we closed, and this is strange. We don't see this very often. We've closed for 2 days, 2 or 3 days above the upper Bollinger Band on the daily chart, and we're also closing above it on the weekly chart. Usually it's just one or the other. It's not both. And this could mean that the market is due for some kind of consolidation. It could be that we pull back in price. It could be that the Bollinger Band goes up, or it could be a combination of both of those things happening. But to see this extreme reading, because that doesn't happen very often here, and it doesn't tend to last very long when it does. And momentum, trying to look a little bit better with slope, pretty much flat still with the TSI. The MACD with our intermediate term oscillators, seeing a little bit of an improvement here, but just a lot of choppiness right now where it's a little more clear cut and we're turning back positive on the daily charts. And seeing not much of an improvement with the Chaikin money flow, and we're watching that on the daily charts too. Now we're still positive here since we're above zero, but you can see the red line is going flat. And Chaikin oscillator, after getting an extreme negative reading on the daily chart, it really started to turn and has gone back to positive. where we had been declining here on the weekly chart, but we had an up week this past week. The force index is quite positive right now, and we're above 50 and advancing with the money flow. And this is just 1 week to the next week. We saw a pretty big move. And we go back 50 weeks, also still looking quite positive here. And then with the RSI 14 week, we're above 50 and going up. That's just showing good solid momentum that way. We're getting a little extreme positive with the Stoke RSI. The special K, which is a long-term oscillator, it could just be getting ready to cross positive. We've been waiting a long time to see that, and we are positive on the daily chart. The Williams percent are also showing good longer-term momentum. Ultimate oscillator looking a little extreme, but also shows good momentum. The vortex has the green line going up and the red line going down. That's positive. Copic curve showing this momentum indicator as being positive. And when we were coming down, we came down to the 10-week moving average here. That equates to a 50-day moving average. And we were able to find support and then bounce up off of that. And we're looking pretty solid here with our longer term charts. With the Heiken Ashi, we have the open candles here. We're positive but pointing down with the Kigi chart, where we're looking just flat out positive on the daily chart. The Renko chart here is positive both on the daily and weekly chart. And the 3-line break, also positive on the daily and weekly chart. Looking good here with the ease of movement. That's turning more positive. And we had some new X's drawn in here. We have a triple top breakout that was generated back on September 16th. And we're seeing positive signs on the daily point and figure chart as well. Momentum still looking pretty solid in the long term. Kind of chopping a little bit sideways now in the intermediate term, but a big improvement here in the short term. And I decided not to show this chart. Well, now I decided to bring it up again because we started a new cycle. I didn't put the date on here, but it was right around the time of the election. And we'll have to see if this ends up meaning anything. I use this more for entertainment. I don't really make decisions based on this because it's hit or miss. And if you draw enough lines on here, you can get it to say whatever you want. But I thought this was kind of interesting that just about the time we were having some problems, we were starting a new 50-day cycle. And to this point, looks like the cycle is changing more positive. But that could change back at any time. We are positive with the Elder's Impulse system here for the S&P, and we're positive with the parabolic SAR. Then looking at the S&P setting all-time highs, mid-caps all-time highs, not quite back to an all-time high yet. We might be getting kind of close here, but the small caps have been more frustrating. We're wondering if they're coming into a more favorable environment now. The Dow setting an all-time high, the NASDAQ all-time high, NASDAQ 100 all-time high. There's another look at the QQQs, the NASDAQ 100 all-time high, mid caps setting an all-time high, small caps, I guess we did set an all-time high here going back. It seemed like we were getting close there a few times and then they would fall back. And so we'll have to see if things are shifting and looking more positive for the small caps. All-time high with the NYSE, the Wilshire 5000 all-time high. Now, this is a daily chart here. And really looking positive with all stocks. 30 biggest software companies, not back to an all-time high, but really showing some strength lately. ARK even had a good week, believe it or not. It was up almost 16% for the week. The FANG index coming back in and setting a recent all-time high, not on Friday, but it did on Thursday. And the banks are looking good, maybe a little overextended in the long term when we look at the RSI, but the momentum is also positive. Not back to an all-time high here. And we look at traditional Dow theory with the Dow setting an all-time high. And on a closing basis, we did set an all-time high with the transports, but you can see this intraday, intra-week bar here. We didn't quite exceed that. And the utilities had been just really doing strong. Now we're starting to see some weakness coming into that area. And November tends to be pretty positive. Going back to 2020, we're up 80% of the time with a 5.9% return. And then commodities, which are kind of, okay, are we going to go up? Are we going to go down? Well, in the meantime, they're kind of going sideways. Oil is still hanging out around that $70 area, and we're watching that for geopolitical reasons. seeing a real bounce up in the dollar. We got up into the 105 range earlier in the week, but this is a line chart based on a weekly value here, and we ended up coming back down into the 104 range. Copper still in an overall uptrend, suggesting the economy is looking good going forward. Gold is still in a solid uptrend, but coming in off of the highs. Silver also in an uptrend, but off of the highs as well. And could be seeing a bit of an improvement here with bonds based on price, but we've dropped below the 50-day moving average. Interest rates going up kind of spooked the market as well. But we're still looking good when we compare stocks to bonds on a monthly chart. And we had been really going back up with interest rates. We were coming down over the last session or two, but we want to see if that can continue. And looking at the weekly chart of the international rates here, with the US and UK having the highest rates, coming down a little bit in Germany, actually going up a little bit in Japan. And the intermarket analysis chart still showing where gold is doing the best year to date, followed by stocks, oil, and then the dollar and bonds are still negative year to date based on price. Looking at the ratio between the Nasdaq 100 and the S&P 500, both had coming off of all-time highs, seeing a little bit of an improvement, but longer term, the Nasdaq is still underperforming. The Nasdaq 100 is still underperforming the S&P. The S&P 100 is outperforming the S&P 500. Growth is still outperforming value, and gold actually underperforming this past week when compared to the S&P, just kind of chopping more or less sideways with this ratio. And we saw gold pulling back a little bit and the dollar going up, but still gold has been outperforming the dollar. Bonds continue to underperform stocks longer term. We're seeing energy underperforming tech. Low volatility stocks starting to come down. We were just getting ready to see a long-term golden cross here. If this could continue to fall, that would be more positive, meaning that the low volatility stocks are underperforming the S&P. Discretionary is really improving when compared to staples, even though longer term it's still in a downtrend. The small caps still underperforming. Now they had a good week and they could be starting to show some signs of improvement, but when we compare them to the tech sector, they're not at the point of outperforming yet. They're still going down with this trend. Longer term, still looking solid here with the NYSE breadth thrust. Seeing an improvement here with the ZWAG NYSE breadth thrust, but no new signals. And we had come down to an 8 reading here with the Zahorchak. Well, with the upward move that we just saw, we're back on a full-on 10. So that it never turned negative, but it was showing a little bit of weakness as the market was a bit under pressure. Now it's looking an awful lot better. Longer term, still looking good with the S&P well above the trend line going back to the 1987 crash. Here's another look at that same chart, well above this trend line here. NASDAQ 100 weekly chart still looking solid, setting all-time highs. Seeing a little bit of an improvement and still above zero when we look at the NYSE new highs minus the new lows. And then this red line is a 50-week moving average of that. And we look at a 50-week moving average just for the S&P, starting to go back up, but still well above zero. The ratio between the NASDAQ 100 and the Dow still looking really solid there. The QQQs and the small caps still looking pretty good there. Watching the 3-month yield, just trying to figure out why has it been declining. Is it because things are falling apart like they were in 2007, or is it just because interest rates are coming down? And seeing a bit of an improvement here with the cumulative new highs, new lows for the NASDAQ. That's longer term positive. And then I got a bunch of seasonal charts here. November tends to be positive if you go from 1964 to 2023. So 1.5% and up 68% of the time. If you measure it from November to April, the return is 7.1% and we're up 77% of the time. Here's one of these median type charts comparing a presidential election year with a non-presidential election year, and we actually do better when it's not a presidential election, but everyone goes, oh, it's an election year, so the market has to go up. But that's not always true. This is taking all years together from 1984 to 2023 and then comparing it to the election years. The takeaway from this is where the dashed line is, what happens after the election? And this is a chart that I usually show every week. Going back to 1950, we're in a period of positive seasonality as we go through November. Doesn't mean it's straight up, but overall, it does have a tendency to go up. And then looking at the monthly returns going back to 1950, November is a very strong month. Internationally, also, the November tends to be well. We take November and December together, those look pretty good. We go from November to January, that period of time looks good. And the whole fourth quarter ends up looking pretty positive as well. And the first half of November, we do well. Second half does even a little bit better there. And then the Carson chart shows the positive seasonality throughout November, going into December, and even into January. And then comparing typically what happened in September and October, which really didn't happen this year, and then how things tend to perform in November and December. I like that. Goodbye, hello. Hello, goodbye. You say goodbye, I say hello. And then looking, no matter how you chop it up, going back to 1950, the last 20 years, 10 years, election year, we tend to be positive in November. And yes, here's another one. November, December, and January are historically the three best months. Then another way here, going back to 1950, we're up 11 out of 18 times, down 7 out of 18 times, with an average return of 2%. Thank you. I hope you have a very good weekend, and I will talk to you in the next video.